Today marks a critical moment in the evolving landscape of digital finance, as Tether, the world's largest stablecoin issuer, announced a strategic acquisition of a major South American agricultural company. This move is not just about expanding physical assets, it represents a deliberate push to link stablecoins with real-world commodities like sugar and corn, while integrating sustainable energy sources through biomass-powered Bitcoin mining operations. This initiative demonstrates how the crypto sector is aggressively innovating, merging traditional agriculture with blockchain technology to create new financial ecosystems that could reshape commodity trading and energy consumption in emerging markets. Bank of America surprised many by releasing better-than-expected second-quarter financial results, primarily fueled by soaring trading revenues amidst ongoing market volatility. This performance underscores how resilient major financial institutions remain despite economic uncertainty. Increased interest income from rising rates also contributed significantly, reflecting how banking giants are capitalizing on shifting monetary policies. These results emphasize the intricate connection between macroeconomic trends and corporate earnings, offering investors valuable insights into how financial giants adapt and thrive in turbulent environments. In a groundbreaking development, Bank of America revealed its intention to launch a proprietary stablecoin, joining Morgan Stanley, Citigroup, and JP Morgan in the race to issue digital currencies under a more favorable regulatory framework. This collective interest from legacy banks signals a critical turning point where traditional finance increasingly embraces blockchain technology to streamline payments, reduce transaction costs, and enhance cross-border transfers. Such efforts highlight the transition from speculation to practical adoption, underscoring stablecoins' growing legitimacy as financial infrastructure. Goldman Sachs continued its momentum by surpassing quarterly profit expectations, driven by record levels of equities trading and robust deal-making activity despite volatile market conditions. The bank's ability to leverage market swings for profit demonstrates a sophisticated risk management approach and adaptability. This success also reflects broader market dynamics, where volatility, though often feared, can generate significant opportunities for well-positioned players. Investors following these trends gain a clearer picture of how market turbulence can be harnessed strategically rather than avoided. Morgan Stanley reported strong second-quarter profits, primarily due to gains in trading, although their investment banking revenue declined slightly. The cautious tone in the firm's outlook, paired with ongoing consideration of acquisitions, suggests a balanced approach to growth amid uncertainty. This measured strategy illustrates how financial powerhouses weigh risks carefully, aiming to preserve stability while seeking expansion. Understanding such corporate decision-making offers viewers a practical lens on how market leaders navigate complex economic environments. Legislative developments took a dramatic turn as former President Donald Trump played a pivotal role in pushing forward key crypto bills stalled in Congress, including the Genius Act, Clarity Act, and Anti-CBDC Surveillance State Act. Trump's involvement reinvigorated momentum, breaking procedural deadlocks and forcing renewed debate on digital asset regulation. This political influence spotlights the increasing entanglement of crypto policy with national politics, where decisions made today will profoundly impact innovation, privacy, and financial freedom in the years ahead. Trump's outspoken criticism of Federal Reserve policies and call for aggressive interest rate cuts introduced significant volatility into markets, challenging conventional expectations. While inflation data shows resilience, these political interventions complicate monetary policy forecasts and raise questions about the Fed's independence. For investors, understanding this tension is critical as it influences bond yields, stock valuations, and currency movements. This episode reveals how political voices can dramatically affect financial stability and market psychology. Markets reacted sharply to rumors that Trump might fire Fed Chair Jerome Powell, with the US dollar depreciating significantly and Treasury yields falling. This development fueled uncertainty about the direction of US monetary policy and underscored the fragile balance between political power and economic governance. Such events exemplify how geopolitical dynamics ripple through global markets, reminding investors of the importance of monitoring political signals alongside traditional economic indicators. Wells Fargo announced plans to expand its healthcare sector team within its commercial banking division, aiming to capitalize on growth opportunities in healthcare financing. This strategic expansion reflects a broader trend where banks diversify portfolios into stable and expanding sectors, mitigating risks from volatile markets. For viewers, this signals how shifts in industry focus by major banks can herald emerging investment opportunities tied to demographic changes and evolving economic needs. Asian financial markets experienced mixed performance as U.S. inflation data tempered expectations for Federal Reserve rate cuts. Key technology stocks such as Nvidia rallied while cryptocurrencies saw modest recoveries, demonstrating the interdependence between global macroeconomic data and asset class performance. These market responses provide a real-time case study of how investor sentiment adjusts rapidly to new economic data, influencing portfolio strategies worldwide. The Consumer Price Index in the U.S. rose by 2.7% year-over-year and 0.3% month-over-month in June, marking the steepest monthly increase since January. This uptick was largely driven by rising energy costs and lingering supply chain disruptions, fueling concerns about persistent inflation. Such inflationary pressures influence Federal Reserve policy decisions and have direct consequences on borrowing costs, consumer spending, and corporate earnings. For the financial audience, interpreting these numbers is crucial to anticipate market trends and adjust investment approaches accordingly. Ongoing U.S. trade tariffs continue to exert upward pressure on producer prices, which are rising faster than consumer prices. This divergence indicates that inflationary forces are infiltrating the production side, potentially leading to sustained higher costs for manufacturers and ultimately consumers. Recognizing these inflation dynamics helps investors understand broader economic trends beyond headline CPI figures and anticipate how corporate profit margins might be affected. Bitcoin's price showed resilience by rebounding to approximately $118,800 following legislative procedural setbacks. The cryptocurrency's recovery coincided with signals from political leaders that regulatory frameworks will advance, providing market clarity. Moreover, major altcoins like XRP, Solana, and Ethereum also experienced price upticks, suggesting renewed investor confidence. This recovery underscores the symbiotic relationship between regulatory clarity and digital asset market performance. Billionaire investor Peter Thiel made headlines by acquiring a 9% stake in BitMine Immersion Technologies, a firm holding over $500 million in crypto assets. This significant investment boosted the company's stock price by 30% pre-market, demonstrating how influential backers can sway market perceptions and fuel enthusiasm for crypto-related ventures. For viewers, this highlights the growing role of prominent institutional players in shaping the trajectory of the crypto economy. Market analysts observe that Bitcoin's recent rally is increasingly driven by institutional demand, rather than pure speculation, supported by rising ETF inflows and futures activity. This trend suggests a maturation of the crypto market, with more sophisticated capital entering and creating a stronger foundation for price stability and growth. Understanding this shift helps investors discern between hype-driven bubbles and sustainable market movements. Citigroup announced it is considering launching its own stablecoin to expand digital payment services amid intensifying competition in the banking sector. Such moves reflect a strategic recognition that digital currencies will play a critical role in future financial systems, compelling legacy banks to innovate or risk obsolescence. This trend also signals potential changes in how everyday payments and settlements might evolve globally. The US dollar strengthened against the euro as traders reduced expectations for Federal Reserve rate cuts following robust inflation and producer price index data. Currency markets remain highly sensitive to economic indicators, making forex trends an essential aspect of financial analysis. This dollar appreciation impacts international trade, commodity prices, and investment flows, demonstrating the interconnectedness of global finance. U.S. producer prices remained flat in June, indicating that while goods inflation persists, it is offset by stable services costs. This mixed inflation signal complicates the Federal Reserve's decision-making and reflects a transitional phase in the economic cycle. Investors monitoring these nuances gain an edge in predicting monetary policy moves and adjusting asset allocations. In Congress, 13 Republican lawmakers blocked procedural votes on key crypto legislation despite efforts by leadership and former President Trump to separate bills for easier passage. This internal division illustrates the contentious political environment surrounding digital asset regulation and the challenges ahead for enacting clear laws. For stakeholders, tracking legislative dynamics is crucial to understanding the timing and substance of regulatory developments. The Genius Act, a central piece of crypto legislation, remains stalled due to procedural hurdles, but bipartisan efforts and pressure from influential political figures aim to revive it through separate votes. Industry leaders emphasize the act's importance for legal certainty and market growth, framing its passage as essential for the future of U.S. financial innovation. Staying informed about this process enables viewers to anticipate shifts in the regulatory landscape and market opportunities.